In today's video, I'm going to share with you the only thing you need to be successful in Forex trading. Not market structure, not order flow, not any fancy name that is being thrown around out there. The only thing you need is price action. And how do you apply this price action? You only need the opening price strategy. And these few days, I've done a lot of video on opening price. If you have not seen any of it, you can check the link in the description. The opening price is simply looking for your setup at the opening prices. And there are different types of opening price. All right. We have the first one, the reversal opening price. This is where you see a bullish and a bearish candle. Just like this, a bullish candle and a bearish candle. The line above here, you simply mark here and pull it out. This is the opening price. Okay, this is called the reversal opening price. Why it is a reversal? It is a candle that reverses the previous candle. Simple. The candle that reverses the previous candle is a opening price, and this is the reversal opening price. These are the prices where market respect. If market wants to move higher from here, it has to reject this level and then push. If market closes below this level, there is tendency that it would attract the other opening price. I will get to that shortly, but stay with me. Do not go anywhere. Now, for the bullish setup, we have a down candle and an up candle. So you simply mark out the line, pull it out. That is the reversal opening price, which serve as support and resistance. In this case, we are not marking a zone. We are only simply marking a single line so that we can easily make decision around it. A close above simply means price want to go higher. A rejection on that simply means price want to go the other direction. That is the reversal opening price. The other one, which I will show you on the chart once I'm done explaining this. The next one is continuation opening price. This is the opening price that continue the previous candle direction. This is the previous candle, and then we have another candle here. The opening price of this candle is your support and resistance level. In this case, this is the resistance. So when price come back there, you want to take trades around that area, not the other block, all right? Not a zone. The problem with all those other points of interest is that there is zone, and it becomes so complex to trust. But with a line, you can easily make decision. If you have to sell, for example, and price close above it, ignore it and move to the next one. Another one we have here is the bullish continuation opening price. In this case, is a candle that continues the previous candle direction. In that case, simply mark a line. And what are you looking for? You simply want a scenario by if price come back there, you want that area to serve as a support to push price to the upside. This is used to continue the trend. The reversal opening price is mostly used for reversal of a trend, or at least it might begin the impulse leg. This is what I mean. If you have market like this, all right, most of this pullback happens around the reversal opening price. Most of this pullback happens around the reversal opening price. Most of this pullback happens around the reversal opening price. Then this leg, if you look at it, there are candlesticks. Most of this push up here happens within the continuation opening price. It continues the move. The reversal opening price most times might start the reversal or a retracement for further push in price. So in case it starts a reversal, most of the time, check it out. It is a reversal opening price. Now, the last one here that I want to talk about, and then we look at how you can use this to make entries, okay, to gain entries in the Forex market or any market you trade. So the next one here is the Quasimodo. Quasimodo in the sense that we all know the Quasimodo pattern. This is a Quasimodo. Price is moving up. Then we have a break of this. So This is a typical Quasimodo. We have a neckline here. Price breaks this, and then if you are trading the Quasimodo strategy, you take your entry once price come back to the Quasimodo line. All right. But for me, I realize the week are filled with manipulation. Those are not the true prices of the asset. Most of the prices in this week. So what you need to do is to mark out, instead of marking out this week, you mark out the reverse opening price on that left shoulder of the Quasimodo. Pull it out so that when price comes back there in the future, you want that area to serve as what? Resistance. Same thing here. When price, is not on the line, pardon me. When price come back there, you want to use that area as area of what? Support to push price to the upside. So how do we use this information? Because I've been giving you a kind of knowledge on this opening price. Now is the time to use an entry model in line with this. So to get an entry model, we need to have two things. To get an entry model, we need two things in place. Number one is the setup time frame, and number two is the entry time frame. Now, by setup time frame is simply the time frame where you are looking for your opening price. You are looking for the opening price here. So the setup time frame is on the weekly, daily, and monthly. Do not go below the daily. Do not go below the daily. Once you go below the daily, there will be too many signs for you, and which might lead to confusion. Now, the entry time frame is the 30 minutes, 15 minutes, and the 4 hours. Now, let me explain. If you mark out an opening price on the weekly time frame, your entry time frame will be the 30 minutes. Your entry time frame will be the 30 minutes. And what are you looking for within this 30 minutes? You can look at different price action. All right. But in this video, I'm going to tell you what you should be looking at. You should be looking at bullish or bearish engulfing. Bullish or bearish engulfing. And how do that look like? For example, if I have a bearish candle here, and the previous candle, let's assume, let's change this to green. We have a bullish candle, then we have this bearish candle. This bearish candle engulfs the entire candle of the green candle. So once you see this at area of resistance, all right, you see this at the area of resistance, this signal that the price is about to fall. And once this candle closes, you take your entry, stop loss either above this, or if there's a deep push inside before this is formed. For example, if you have price came into that level and then push higher before forming this, you can use that last high as your stop loss. If you want to be aggressive, you can use the stop loss that is few pips above the engulfing. But to be safe, or when you are practicing this so that you have a higher win rate, I would recommend you place it above the last high that is there. That means every form of manipulation will have occurred at this point. So when you see the engulfing, you sell. Same thing you look for on the support. We have a bullish candle engulfing a bearish candle. So this is a bearish candle. I have to change the color to red. So once you see this, this is your entry signal. So all you need to do, once this candle closes, you buy and stop loss below or the last low that was manipulated. Okay, and then you target whatever RR you want to target. This is not about me telling your target. Most of the time, the targets are, we run into swing targets, especially being the weekly level. So what are you looking for when your line is on the weekly? On the 30 minutes, you are looking for engulfing. You are looking for engulfing. only on the 30 minutes. Don't go below 30 minutes for weekly. Don't go to 5 minutes for weekly. And then if it's on the daily, daily, you marked out your opening price as your support and resistance level. Where do you get your entry time frame? Is only 15 minutes. 15 minutes. There are different ways. It's not only engulfing. You can use any other one. It could be a change in market structure, whatever you want to use. But the key here is those area, the price, which you expect price to where you expect the market to respect. And this is the price. The closest to that price is the opening price. The closest to the price is the opening price. So once the price gets there, once the market gets there, you simply look at any candle formation you want to look at. There are different candle formations. But for this example, which is one of my favorite, is the engulfing. So we are going to go to the chart to see how we can apply this on the chart. Now, mind you, you can take this information and backtest and even refine. You can use different formation, maybe flag pattern, whatever you want to use. You can use a shooting star, morning star, tree, all those price action formation. They are very, very important in trading. Do not let anyone deceive you. They're very, very important. So without wasting time, let's look at the NAS 100. So on NAS 100, we can see that this market is bullish. You can see it creates more higher structures, and we are trading way above the 100 moving average. And then you can see we are breaking resistance to the upside. So this move is a pullback. And now I'm looking at taking entry around this opening price. This is the reversal opening price, as I showed you in the illustration part of this video. You can see a bearish candle and a bullish candle. Why am I picking this level? One of the reasons why I'm picking this level is that it has engulfing, but that is not the criteria, okay? But once I don't see my confirmation within this, I will not take my trade. Then I have this level, and this level. So let me quickly put it at the end of this continuation. We have different continuation opening price there. All of them still need confirmations. So the question is, which one of these will hold? That's what I'm showing you here. You need confirmation. And that confirmation is the engulfing candlestick formation we are looking for. And then the last one here, which is the reverse opening price here, that started the move. This is on the weekly. Take note. So since this is on the weekly, our entry should be the 30 minutes time frame. So let's quickly play this out. Okay, as price is approaching, let's go to the 30 minutes and then monitor for the bullish engulfing candlestick formation. So I'm going to play this out. Price is coming down. I could have got closer. Okay. Now, finally, price is in. Now, the moment price gets in here, this is the first line. Can we see any bullish engulfing? When you look at, we came low, we closed below. Price tried to push up, came back down again. And you can see this closing below is a bearish engulfing. This is not a good sign. Don't go and buy because Raba said buy at the weekly opening price. There's no sign for you here. Okay, so we continue. Do we have engulfing? We don't have here. You can see this red candle, this is blue. There's no engulfing. So we continue. Price jumped. Maybe this is over the weekend when price opened on Monday. As you can see, this Sunday, yeah. Things like this happens on Sunday and Monday. So it closes below. So there's no what is it called? Bullish engulfing. We continue. Price keep going. Do we have any bullish engulfing? No, no bullish engulfing. So we go down and say price came into the second one. But what can you notice here? We have the bullish engulfing here. So in this case, you can easily come here and take your entry long. Immediately this candle closes, you put it on the closure, not on the wick. That's where your entry is. Then the low, you can put it just below this. This is the low. This candle probably manipulates. This is the last stroke that kills or that breaks the camel's back. All right, that's where you put the stop loss. You can put it here, but it will be too aggressive. Remember, we still have a level here. So in order to be safe, we can say put it just below this week. And that is how many pips stop loss? Like 23 pips based on the NAS 100. And then you can target, go back to the daily or 4-hour and target the opposite reversal opening price. So in that case, let's see what we have. So price started pushing high. We almost got stopped out, but you can see if you have put your stop loss here, this will have taken you out. That's it. Now, when it takes you out and you see yourself getting losses, but price eventually going your direction, you can adjust your stop loss. That simply means the trade management isn't as good as you wanted. So price came in but did not take out this low. And then you watch as price push. And you can see we still have this engulfing here. We still have this engulfing. This is our entry. All right. And if we can see on the bearish side, there's not much engulfing again after this occurred. The only attempt is here, but it's not suitable. It only happened around on its own. So we continue pushing. You can see we have another engulfing here. This simply means a sign that price will continue pushing higher. So you continue like that. Let me go to the 1 hour and then push it faster. So as you can see, price takes so much time before flying. Now all this, it all depends on the trade you are taking. Remember, this is more like a swing trade, so you are going to hold it for days. Let price do its thing. If you look at the price action here, this is the 1 hour. I can even see another form of engulfing. If there's another form of engulfing taking place here, this should give you confidence that okay, after holding this for a while, it's always very difficult when it comes to emotions, but allow the process to work and then you watch as price move up in your direction. Let's go to 4 hour. So price push higher, and then this is the random setup profit target. Most times this is where you should be targeting this 4 hour opening price, and this will give you a nice 5 risks to reward. So the next one I'm going to show you is on gold, which is on the daily time frame. When you are using the daily time frame, you use the 15 minutes. So this was one of the trade I call out my audience. And how were we able to take this? So you can see we have a reverse opening price here. This is a strong reverse opening price with a strong bullish engulf, and we close above the resistance there. So all you need to do is to wait for price to patiently come into this level. Remember, before now we have different points. We have another point here. Okay, so you have to monitor those areas to see the bullish, bearish, engulfing, bullish engulfing candlestick formation. So all you need to do, let's Let's go to the 15 minutes and see as price approaches this level. So this is the 15 minutes. We are going to play and watch price approach this level. Now, when price comes in here, this first support, do we have any form of engulfing? No. Instead, we have a bearish engulfing. It simply means, no, we are not taking entry here. So all we need to do is to wait for price to push down. It won't form another bearish here to go down. So we need a bullish, bearish, we need a bullish engulfing candle. So we allow that to play. Now price came aggressively. It pushed up. Price push up. Yeah. At first, it created a bullish engulfing here. All right. Now, in this case, remember, you are trading intraday. This is our entry. This is a long entry. The money price closes. And then your stop loss below or below this low, yeah? Depending on your target, this market will have either given you a 1 to 3 hour trade or a loss. It does not matter. Okay, now I don't want to teach you trade management here, how you manage your trades and what you need to see to know if the price after pushing a bit higher will try to come back to give you another formation. But when this takes you out, you don't panic. All right, you simply wait again and look for a bullish engulfing. Now you see another bullish engulfing here. We took a loss here. Now this time around we have another entry. Immediately candlestick stops, or yeah, when it forms, you take your entry and then stop loss below this low. This, you can see the manipulation here. This wasn't the manipulation. All right, and this is the manipulation here. Now this first engulfing is for this level. Price push above but strongly close below. Tap into this last one here. So this last one is another entry. That means this line has failed you. This support line has failed you. You took an entry here, which is the right thing to do. Push up. It depends on how you manage your trade. Price came back down, took you out. Tap into this. This is your second line. Remember, this is the reverse opening price here. So price came in, rejected, giving you an engulfing. So let's go to the, maybe back to the daily and then see this push higher. So you simply target this level, yeah, and then on the daily, you can see this is your target on the daily. Don't overshoot it. This is your target. You can see you have multiple reversal opening price there. So that is your target. Price push, and then finally got to that level. Okay, and this is where price is currently. This is where price is currently. This is the current price action. Okay, so this and more you can practice and practice. I don't want this video to be longer than usual, but I'll do a part series, maybe part 2, to show you with other currency pair how it works. So in today's video we did that of NAS 100 and gold. In the next video it could be on currency pairs. If you want to learn this, how I do this, there's a link in the description to join the free mini course. I will be sending you emails every day from Monday to Friday. And also, if you want to join the Signal group, the link is in the description. Join and then be part of this awesome family. And if you have not watched the video on the opening price trend strategy, you can watch it at the end of this video. Take care. Bye-bye.